showed you is the system breaking. And when the system breaks, it can do it in a very big way. If you can remember what it looked like in September of 2008, we were getting signals way before that. That's probably why central banks began to load up on gold and not sell as much of their holdings in 2005, a full 3 years before it became obvious to you.
The next day, the 29th, is the first day of delivery for the December contract. There is rumor that somebody, this is a rumor, tried to purchase and stand for delivery on $40 billion worth of silver, and bang, they shut down the CME, the COMEX, at 10 or 11 o'clock at night on Friday night, Thursday night, Thanksgiving night. Now, there's no volume going through these servers at this point, right? But the server center in Illinois evidently overheated just in the metals side of things. They have servers for all other markets that are controlled in the CME group, Forex and currencies and equities. Those are fine.
This chart is from the Federal Reserve, are those overnight repurchase agreements. And look at, this chart goes back to what, 2001? Something like that. And the lines are itty bitty. You can't really see them because what they've had to do since 2025 is much larger. That's why it looks itty bitty. And this is not really a good thing. So you can see these are Treasury securities that are purchased by the Federal Reserve in those overnight purchase agreements. Doesn't that look like a crisis to you? You saw that teeny weeny piece in 2019. You can't even see it here. It's a blip. It's nothing. And that brings to the point, if you don't hold it, you don't own it, and these markets are very, very susceptible. And you can't see the internal plumbing and how that's breaking down. But that's really what I'm showing you. Whether you understand this or that or the other thing, you can see the extreme changes in these charts. That's really what I'm trying to show you. They are in a big, huge battle right now, and they want things to appear calm on the surface so that, hey, it's Christmas time. You can enjoy the holidays. You, the public, go spend. Take on more and more and more and more debt. Everything is hunky-dory. We've got everything under control. You look at those charts, and can you bring me back to the chart, please? That one. Does that look like everything is hunky-dory on the end with those big, huge spikes up? No, that shows panic. That shows breakdown. And you don't really need to know it in more detail than that. You just, I'm always talking to you about pattern shifts. And when a pattern changes, it means that something underneath has changed. And this is showing you it's changing in a rather big way. So if they do indeed go in, which there's really no choice, can they let the money market funds, can they allow the stress that's in that system become visible to you? You might not want to put money in a money market fund if that were the case. And then you might make a different choice. Because once you really understand what's happening to the money, I'm telling you, you make different choices. And you better make those choices ASAP, because this is showing you full and well a complete breakdown of the system.
While holiday seasons often come with messages of optimism, the economic machinery tells a different story. Policymakers want consumers feeling confident, spending freely, and taking on debt without hesitation. Yet behind that facade, the structure supporting U.S. money markets is showing fractures. Sharp, abnormal repo spikes betray hidden panic, not stability. Beneath every sudden shift in pattern lies a deeper change in the system's foundation. The question is no longer whether stress exists. It's how long authorities can keep it out of public sight. When liquidity freezes or confidence evaporates, the veneer of normalcy disappears all at once.
The deliveries in particular in London and on the COMEX, but mostly in London. I've been screaming about the central bankers buying gold and silver, but things have really changed, especially, I guess you could say, in silver, and especially here in the United States. Some of the big things that have happened, maybe the biggest thing, is that the United States government has classified silver as a critical mineral. Now, that's a very big deal. In other words, they're putting a floor, a policy floor, a national security floor under the price of silver. And they are acknowledging for the very first time that silver is incredibly important. Now, from a standpoint of what's interesting about that is that it's been the Western banks, 8 of them, half in the United States, half in Europe, roughly, that have held down or maintained the largest concentrated short position on COMEX in the history of the exchange in any of the 1,000 commodities traded in silver. Now, that's been going on for years, and I have my own beliefs behind it. I believe it is the military-industrial complex who rules the world through high-tech military components and the need for copious amounts of silver to make these components to sell to the Western governments around the world to rule the world, as they have for a very long time with very, very strong militaries. They are the ones that I think have been behind. The question is, why would 8 banks have the largest concentrated short position for years and years and years? JP Morgan, the custodian of the world's largest silver trust, SLV, paid the largest fine the Justice Department ever handed out for manipulating the market, metals market, yet they're still allowed to be the custodian with BlackRock of the world's largest silver trust. Who is a military-industrial complex? Well, I would argue it's BlackRock. They own the majority of all the military manufacturing companies. And when countries like the Ukraine get destroyed, they're the ones that come in with the missiles that we build for many of the countries around the world. They're the ones that get the reconstruction contract. I will move away from that a little bit, but just to set the stage.
In 2024, the U.S. officially classified silver as a critical mineral, a move that quietly transformed the metal's strategic importance. After decades of suppressing silver prices through concentrated short positions on COMEX, Western institutions now face a supply chain they can no longer control. London's vaults, once holding over 1.18 billion ounces, have drained to under 800 million, and only a fraction is freely available for delivery. Meanwhile, outstanding contracts represent nearly 2 billion ounces, far exceeding available stock. This mismatch is why major exchanges are experiencing delays, settlement difficulties, and growing signs of structural stress.
So far this year, almost 13,000 tons, probably after the last 3 days, which was the December delivery, which started 3 days ago, about 13,000 tons have stood for delivery. And that exceeds the combined output of the 3 largest producers in the world, Mexico, China, and Peru. And, this is not a small deal. You take a look at the amount of silver in London. They started with 1.18 billion ounces of silver, call it 2021. It's down to 790 million ounces. But of that 790 million ounces, only 140 million are available for delivery. The other 550 belong to the ETFs, in particular SLV. What's interesting about that is that there is 2 billion ounces in contracts that are outstanding that could stand for delivery. So what could go wrong, possibly go wrong, with 2 billion ounces in spot contracts that could stand for delivery already out there, backed by 140 million ounces of free float? This might be why the LBMA, in regards to silver, which is the oldest silver market in the world, the London Bullion and Metals Association, 140 years old, they are a T+1 settlement. T, Monday, +1 Tuesday. Wednesday, the bar should be moving to you. You and your brother own a massive jewelry conglomerate, and you manufacture jewelry all around the world and sell it all around the world. So you have contracts in London. You need your gold and your silver to make your jewelry. And so you and your brother say, yeah, we need to get to take delivery of a bunch of stuff here. Let's do it. And they call you up and say, guys, I'm sorry. I know you're expecting your bars in 3 days, but there's a shortage of manpower in trucks in London at the Bank of England. We are about 8 weeks backordered. Really, that's how that works. So you're beginning to see this. We saw something similar but different Thanksgiving night.
I just showed you is the system breaking. And when the system breaks, it can do it in a very big way. If you can remember what it looked like in September of 2008, we were getting signals way before that. That's probably why central banks began to load up on gold and not sell as much of their holdings in 2005, a full 3 years before it became obvious to you.
The London Bullion Market Association, 140 years old, is supposed to deliver metal within 1 business day after trade settlement. Yet jewelers, refiners, and industrial buyers now report waits stretching up to 8 weeks. On COMEX, delivery pressure has become so intense that servers managing metals trades experienced a mysterious shutdown during an unusually low-volume holiday night. Whether technical failure or intentional throttle, the outcome is the same. Markets designed for cash settlement speculation are being forced into physical delivery. As more participants demand real metal instead of paper claims, the system's weak points are being exposed rapidly and publicly.
But I started talking about this in a big way in 2000, and there were a lot of things that were happening in 2006 and especially in 2007 with a lot of things breaking down. And so do the absolute specifics matter? Not really. I don't think they do. I pay attention to the specifics, but do you absolutely need to know exactly what this little piece is and this little piece? No. What you need to understand is that there is a pattern shift that is happening right now that is not good, right? Why isn't it good? Because the central bank should not have to buy back the treasury bonds, period. But I showed you the run. What does that mean? A lot fewer buyers of that. And since those treasuries are the foundation of the global financial system, that means that they count on buyers of the treasuries. And yes, President Trump signed into law the Genius Act to create a new artificial market for treasuries and for dollars. Is it going in place fast enough that this can continue to be covered up? No. And in my opinion, and I could be wrong because this is absolutely my opinion, I don't have any hard data on it yet, is that those stable coins will be used to usher in and make visible that hyperinflation. So we still have a little ways to go for that. And the public has to lose all the confidence. So all of this printing that we've been talking about this morning, that is most likely to speed up the rate and the height of the inflation. And it's the holiday season, so people are feeling, I don't know, I can't say this about everybody. I'm sure there are a lot of people that are very stressed going into this holiday season, but it is a time of hope. And so people will be more hopeful. But hopium is not a plan.
Before the 2008 crisis became visible, central banks quietly accumulated gold. Today, a similar pattern is emerging, but on a much larger scale. For over a year, each COMEX delivery cycle has seen enormous volumes of gold and silver removed from the system month after month. Billions of dollars worth of metal have flowed into the hands of undisclosed buyers, likely sovereign wealth funds, major institutions, and central banks. These shifts suggest growing doubt about U.S. treasuries, which remain the global system's foundation. As international demand softens, the Federal Reserve is forced to absorb more supply, accelerating inflationary pressures.
The next day, the 29th, is the first day of delivery for the December contract. There is rumor that somebody, it's a rumor, tried to purchase and stand for delivery on $40 billion worth of silver, and bang, they shut down the CME, the COMEX, at 10 or 11 o'clock at night on Friday night, Thursday night, Thanksgiving night. Now, there's no volume going through these servers at this point, right? But the server center in Illinois evidently overheated just in the metal side of things. They have servers for all other markets that are controlled in the CME group, Forex and currencies and equities, those are fine. But the servers, which have double and triple redundancy for air conditioning if they overheat, double and triple and quadruple, well, those specific servers just for the metals market on Thanksgiving night when there is no volume, everyone's eating dinner, they overheated and shut down for 12 hours. Things are beginning to break within the system, and they're beginning to break because no one ever stood for delivery, Versailles. No one ever did, less than 1%. And now everyone is standing for delivery. It is the Achilles heel of the system. People would roll it over. They would take cash settlement. They would use it to speculate. Now they're saying, nah, no, I want delivery. In the first 2 days of the December delivery month, the first day we saw 23,970 gold contracts, which is 2.397 million ounces. First day we saw 8,305 silver contracts. Now the gold contracts are 100 ounces a piece, so that's 2.4 million ounces of gold at $4,000 a piece plus, and 8,305 silver contracts, which is 41,525 million troy ounces of silver issued and stopped. That was day one, just day one. And by day two, we saw day two, 2.397 million ounces of gold, 41.525 million ounces of silver stopped and issued. That means delivered. It's happening every day. Every single month since November of last year when Trump won the election, we have seen these kinds of numbers.
Something unprecedented is happening on Wall Street. Senior strategists at Morgan Stanley, Bank of America, and renowned bond investor Jeffrey Gundlach are openly recommending gold allocations not seen in modern finance. Long-standing models like the 60-40 portfolio are being rewritten in real time. Analysts who once dismissed precious metals are urging clients to shift 20 to 25% of their assets into gold and silver, levels historically associated with crisis preparation, not routine diversification. Institutions are positioning early, quietly accumulating physical metal while the mainstream financial press remains silent. When sentiment finally shifts publicly, the major players will already be fully invested.
Massive, hundreds of billions of dollars worth of gold and silver have come into the COMEX since November. No one's asking who's doing this, who's taking possession of this kind of volume. So things are changing. And I guess I would simply say this. You have the most well-funded and, more importantly, well-informed traders that have done this going on 5 years, the central banks that are now, it's transitioning into the commercial banks, and it's transitioning into the most sophisticated traders here on Wall Street. One last thing, and I'll shut up. One thing that I've never seen before, ever, never, right? When you talk about what's happening in metals, I have never seen this before. My whole career will be 36 years in February. No one has ever on Wall Street acknowledged gold, never. And when I say gold, I mean silver too. But they never did. And you would get some advice. Edward Jones guy would say, fine, put 5% of your assets in gold, fine. Well, three things that I can point to that I'm blown away by. Now, the three things I'm going to mention, these people are talking to the people way up here. They're talking to the people bringing the metal into the COMEX. Number one, the chief financial officer for Morgan Stanley. Now, I have an account at Morgan Stanley, and the guy's a very good friend of mine. And he's one of the biggest money managers in the United States. He manages over $4 billion in Morgan Stanley. Wouldn't know a gold coin if it fell on his foot. But their chief investment officer just came out and publicly said the 60-40 mantra platform that Wall Street has used for the last 50 years is broken. And that would be 60% stock, 40% bond. You retire, you're 55, 60 years old, you're going to retire. They'd say put 60 in stock, 40 in bond. We'll manage it for you. Go have fun. Go play golf. And you would do well. Now he said it's broken. Sell half your bonds, put 20% in metals, 60, 20, 20. Michael Hartnett, the chief analyst at Bank of America, whose newsletter is north of 10 grand and goes to the institutional traders. He says, no, that's not right either. 25, 25, 25, 25. 25 stock, bond, short-term treasuries, metals. And maybe the biggest one of all is Jeffrey Gundlach, the bond king.
Yep.
He is known as the bond king, the antithesis of gold, an asset that pays interest, made his living and his reputation, and is called the bond king. He says 25% gold is not overweight. So you have at the very highest level a change of massive institutional investors here in the United States bringing it into the COMEX and don't tell anyone about it. No one talks about it. Where's the journalistic integrity in the mainstream saying, what the hell is happening on COMEX? My God, never happened this way before. We're net importers of gold. Never been that way before. Where are the Jim Cramer idiots of the world? Where are the people who pretend to be analysts who don't do anything?
Mm-hmm.
And at the same time, you're having the highest level analysts or chief investment officers of multi-billion-dollar commercial banks saying, well, this is where it's going, and sell half of your bond portfolio and buy gold and silver. So things are changing for Sun in a massive way from the highest level up. Hasn't filtered down to the mainstream yet, but that's the way it always works. The big money is always positioned nicely and comfortably before the people on the street figure it out.